Traders, thanks for checking out our learning series. Our goal is to make learning quick and painless. Before we get started, please pause your video and read the general disclaimer carefully. The video structure is start out with the introductions of the subject matter. Then we're going to proceed with the definition. The final closing of the video will be some example. There may be some required knowledge that's needed and will be posted on this yellow box on the right hand side. You can click on these terms to dive deeper into it. So what is a call option? There are two kinds of call option. You can buy a call, also known as longing a call. You can sell a call, also known as shorting a call. So let's take a look at the risk graph for buying a call. You notice the arrow is pointing upward. I like to think of it that you are bullish and you're betting on the market to go upward to win. So let's take a look at selling a call. Notice the arrow is pointing downward. I like to think of it that you're bearish and you're betting on the market to go down and win. For example, we can think of call option in terms of leasing a house with an option to buy. We're going to name the renter Robert Long, who is longing a call or buying a call. And the property owner will be Paul Short, who is shorting a call or selling a call. Let's assume the current market value of his property is $100,000, but he's being the greedy seller he is. He wanted to sell his property for $105,000. Our Robert Long came along and said, Mr. Paul Short, I do not have $105,000 with me, but I do have $5,000 now. I can give it to you. In exchange, you give me 1 month's time to raise the remaining $100,000 to pay you in full. Paul Short, being greedy, he takes the $5,000 and gave Robert Long 1 month's time to come up with the other $100,000 to pay him the balance. So there's 3 possible scenarios can come out of this. 1, the market can go up to $120,000. 2, the market can stay the same at $100,000. Or 3, the market can go down to $80,000. So let's dive deeper into each of these scenarios and see what's going to happen to Robert Long and Paul Short's outcome. In this example, we're demonstrating that the property went up to $120,000. Robert Long went out and met Newman and offered him a discount price to purchase this deal for $118,000. Robert Long's original investment was $5,000, so therefore he profited $13,000 out of the transaction. His return on investment would be 260%. Let's see how that turned out for Paul Short. Paul Short, originally the property was $100,000, but he wanted to sell the property above market value, and Robert Long was willing to take a chance, give him $5,000 deposit and ask to have 1 month's time to raise the other $100,000. Now, by doing that, Paul Short have capped his gain that the most that he could ever make is $105,000, no matter how high the property value goes up. But in this second scenario, we're making the assumption the market will remain the same at $100,000. The original investment for Robert Long was $5,000. So if Robert Long decided not to exercise his rights and buy the property from Paul Short, his maximum loss would have been only $5,000. On the other hand, Paul Short got the initial deposit of $5,000 from Robert Long, better known as premium received in the option world. There's 2 choices that he can do. A, he can go ahead now and sell his property at market value and receive that $105,000 that he wanted originally. Or he can continue to sell his call to another guy like Robert Long and continue to receive another $5,000 for every month that he sold. In this final and third scenario, the market went down and we'll make the assumption that we'll be at $80,000. Now imagine if Robert Long did come up with the money and bought the property cash originally at $105,000. He would have faced a dramatic loss of $25,000. But instead, he went and bought an option from Paul Short for $5,000. So his max loss only be $5,000. What happened to Paul Short? Well, previously the value of the property was $100,000. He got the initial deposit of premium received of $5,000 from Robert Long. That will give him the new basis of $95,000. Well, because the new market went down to $80,000, his unrealized loss only $15,000. But he can continue to sell premium to another guy like Robert Long and continue to receive the new premium every month. In summary, buying a call requires two things. A, you got to pick the right market directions. What do I mean? I mean, you got to know if the market's going to be heading up, down, or sideways. And you also got to know when it's going to happen. Either it's going to happen within a month, a week, a year, 2 years from now. So in order to profit from it, you need to know these two things. But for all things said and being equal, it does provide you leverage, and you do profit when it goes up, and it reduces your risk. A call buyer, I like to think of it, is alert. In summary, selling a call will expose you unlimited upside risk because you are selling a naked call. And the only way you can profit is when the market's going down or on the sideways market. So I like to think of all the call sellers are a bunch of nerds.